Well, hello there, traders and friends right around the world. It is James here with you on behalf of Pivot Point Trading, bringing you this Wednesday afternoon market recap. A very, very important Wednesday afternoon market recap, which it will be. I'm not sure how long this will go for. I have a feeling or a suspicion that it may go for about 10 to 15 minutes. But it's very important that you just understand what is happening with these markets and why they are acting the way they are. Not only that, but really what to expect for the rest of August 2015. Obviously, today we saw a little bit of turmoil across all three of the US markets to begin the day. However, they were bought back up from about mid-morning or mid to late morning through to the close. The Dow Jones Industrial Average more or less closed where it opened. However, it was about a 700-point round trip. So from where we opened to where we put in the low to where we effectively closed was just shy of 700 points on the Dow Jones Industrial Average. Now, to a lot of people, they may not understand why there is so much volatility or what would make a market sell off and then all of a sudden see it rally emphatically as it did. But this is the reason why, and it's something which I've been paying very close attention to and bringing it to that of people in the pro analysis class, which I do each and every week. We've had this long-term support level on the Dow Jones Industrial Average drawn for quite some time. We've had this 17,210 level really as an ultimate target, or at least an ultimate cycle lower type of target, a bearish type of cycle, which has been hit. And as such, we have seen buying pressure off this level. You may be asking yourself the question, well, how did you come up with 17,210? Why is this level so important? And the reason why it is so important is for the following reasons. Not only did we act as support throughout the month of December and also January, February 2015, this is essentially the neckline of what could possibly be a head and shoulders chart topping pattern. Now, for a head and shoulders chart topping pattern to work out, obviously you need a left shoulder, you need a head, and you need the right shoulder. So let me just draw this on the chart for you in a different color to that of red, which I've used to illustrate the neckline of this long-term pattern, which seems to be setting up. Now, if I change my color back to green, really the whole or the entire period of December and January 2015 looks as though it's some form of an LS. This is what we call the left shoulder. Really since February 2015, and I'll try and illustrate this with a different color right here, really I guess March through to June, we have what we call somewhat of a pretty ugly head, but it is what we call a head at least. We've tried to rally back up and break above resistance above 18,300 or even 18,000 on numerous occasions. As you can see, all of these little green lines which I'm drawing, they should be in red, but these are actually resistance levels. The bulls have been trying to break the Dow Jones out, trying to push it up and make the continuation of higher highs and higher lows, but it just hasn't worked out that way. Every time we've pushed back on, the market has sold back off. And here we are in the month of July, August, and moving into September. Whoop, I just lost my drawing, but let me just draw this back on right here. And we're starting to ask ourselves, well, this definitely looks like the beginning of what we call a right shoulder. Now, obviously, if I draw back in or use my illustration with that red line right here, this is the neckline. And for the right shoulder to actually set up, we've been anticipating another rally higher. This rally is something which we forecasted, and it has, in my opinion, and I've said this publicly and on numerous occasions, that it should and will start at 17,210. So what we are looking for really the rest of August 2015 is somewhat of a bullish type of market. Obviously, right now, there's a lot of fear. There's a lot of panic to a degree because of the state of the markets. There's a lot of people really talking about how the markets have pulled back over 1,000 points since the high which we established in May 2015, and how we may be on the precipice of something really big. That may be the case, but it isn't going to work out in the month of August, and it probably won't even work out at least through to mid to late September 2015, because we are right on the neckline and we have to still build that right shoulder. We've been anticipating and expecting what we call the slope of hope rally. Now, this rally, again, is going to be vicious. It'll be very quick. And it will almost work as a level of complacency for people who believe that this bull market is going to continue. And there's a very good chance that we may just, in fact, break above all of these old resistance levels and the bull market may continue. However, the actual chart pattern and the timing of this, if we look at this since December 2014 or even November, I mean, we're moving into the 10th month of a sideways moving market. Not only are we seeing a sideways range-bound market, but we're also seeing varying degrees of divergence and very, very strong levels of resistance, not to mention these lower highs and lower lows, which we have started putting in since May 2015, which is the first beginnings of a rollover. So what we're really expecting once again is to see this rally and a lot of people will probably be suckered into a long-term continuation. But what you want to pay very close attention to is what happens up here at 18,000 on the chart. Again, I will walk through this in great detail with people in that pro analysis class over the weekend, but right now it's not the time to be thinking about initiating short positions. We can say definitively with a great, or to a great degree of certainty at least, that this market is not going to break below the lows of where we pushed during Wednesday's trading session. Sure, we may stumble around this area for a little bit, maybe even 2 days or 3 days, but ultimately we're looking at this market for a bullish pop higher. Now, what I've done also, I've broken down support and resistance. I've gone through the time frame of the market being about 10 months into the sideways pattern. I've spoken about the potential head and shoulders type of pattern setting up and how we're going to form a right shoulder and how important this is right here. The other reason why this level is so critical, this 17,210 area, is because of this red line following up on my screen right here. It's what we call a trend. If I zoom out to a weekly chart, this is something again which I go through in detail in that pro class. But if you have a look at the lows in 2009, we have established 3 fan lines, and fan lines generally work in groups of 3. What these fan lines do are they're just varying angles of the bullish trend. Obviously, since 2009, we came out of the GFC with a V bottom, and the bullish trend was very, very aggressive. It's unsustainable. It's so fast and so high that it was just legitimately, unsustainable. So what happens? We break these fan lines, and then we establish the second fan line, or the second degree of the bullish trend. And as you can see, since mid-2010, we pushed on up all the way through to about mid-2011, and then we ultimately broke the second fan line. This is what has established, up until this date in August 2015, the third primary trend, or the level of this bullish market. As you can see, since 2009, and looking at the third fan line, we have been setting up, again, higher highs and also higher lows. You can see this market continuing to move higher and higher and higher. This is the textbook definition of a primary bullish trend. Now, as you can see, the last time that we actually came back and retested this trend level was back in late 2014. So this is why this target has been on my screen for quite some time. It's just been a very logical area to assume that if the market does go through some form of a correction, that this is going to be the first place in the chart where we are going to see a slowdown and the next influx of buying pressure flow back into this market. When I have a look at this chart on a weekly time frame as well, each one of these candlesticks is 5 trading sessions. It's an entire week's worth of trading activity. The head and shoulders type of pattern becomes even more clearer. You can see right here, I can draw it on for you. We've got the left shoulder right here. We've pushed on up. We've created a head right through to March here. Now we're starting to see the head and shoulders pattern tend to play out. Again, we're expecting a bullish rally higher. It may not even move up as high as 18,000. But ultimately, this is so important for the health of the market into 2015, but also further into 2016. On top of that as well, now I'm going into some in-depth or market analysis, at least on the Wednesday, is that price itself is below both the 100 and the 200. This isn't a definitive sell signal yet. We haven't seen the cross actually take place, but when price holds below these long-term simple moving averages, you need to be very cautious that the trend itself is starting to change from a bull market where these simple moving averages, these long-term trends change from a positive angle, telling us that there is a primary trend in effect or a bullish trend, through to a sideways market. That's why support and resistance and the establishment of lower highs and lower lows, or either the continuation of higher highs and higher lows, is so important at this particular moment in time. Not only that, but if I change to the 50 week or the 50 period and the 200 simple moving average, you can see that we've just got this death cross. Now, this is very, very significant. Extremely significant. This is very, very bearish. Very rarely does this happen. The last time this happened, in fact, was all the way back in the year 2011. So if I zoom back to the left-hand side of my chart over here, you can see we got the cross and we ultimately saw a major sell-off. Now, this was largely attributed to the debt ceiling discussions and the potential or possibility of some form of a formal default, which was never going to happen. It was more so just the establishment, remember, of these fan lines. Number 1, number 2, we broke the second fan line, and since then, we've been above the third fan line or the third sustainable trend. But really before that date, we have to go back to the year 2007 and 2008, and you may start to see some very clear parallels between 2007 and where we are in the year 2015. Obviously, when we count the amount of months, we've got 1, 2, 3, 4, 5, 6, 7, 8, 9. I mean, that's very close to the 10th month that we're currently moving into, and the market itself is range bound, much like the market we're working with. I mean, if you're looking at this picture right here, where would you say that we are in comparison to the year 2007 moving into 2008? And the answer is, if I zoom in very, very clearly on the detail, in my opinion, there's a very good chance that we're actually right here at the neckline of this head and shoulders pattern, where we need to establish once again that right shoulder. So as I break down the markets to you and I say to you, look, I'm short-term bullish on the market. This is the reason why. It is only a short-term sort of bullish outlook on the market. It is going to be, again, a very quick, severe, and probably a very harsh rally, but you're going to want to see once again the establishment of a lower high. So as you can see, as we moved into 2007 and the beginning of 2008, we really started to see these markets set up continuation of lower highs, which was very, very important. We saw that 50 cross below the 200, which has already happened on the Dow Jones Industrial Average. And if I change to the simple moving averages, look at this. Surprise, surprise. We're below the 100 and the 200. We're looking for that rally. And now we have the 100 and 200 in the year 2015 above price. And it's working as a very, very legitimate resistance target, or at least a level to pay attention to on the Dow Jones Industrial Average. Let me pull this map across, or the chart across, and let me show you how close and how similar this picture is. Pay attention right now. I'm holding my mouse down, but pay attention to the month of November 07 and December 07 right now. Pay attention to where price is in comparison to the 100 and the 200, and try and make a visual snapshot or a mental snapshot in your mind right now. I'm going to take my finger off the mouse in 3, 2, 1. And here we are as at the current date on the Wednesday, and look at where price is. We're below the 100 and the 200. We're starting to make again lower highs. We're starting to see price break below the 100 and 200. And as such, we're paying very, very close attention to what happens in this box up here. I cannot make this any more straightforward as what I am doing for you. Obviously, this time right now, really this week or even the month of August 2015, which I've spoken to in depth with people in that pro class, is just how important this month will be for markets globally. It's really not a time to be complacent in the markets. If you don't really understand what's happening in the world or how this is sort of working technically with the US markets, now is not the time to sort of be flying or trying to navigate these markets solo. It truly, truly isn't. So I encourage anyone who wants to learn about technical analysis, or to actually learn how to set trades up or understand market form, and maybe potentially even initiating hedges up at this 18,000 area as insurance, or some form of an insurance policy on your long-term holdings. If you want to hedge against what could potentially be that right shoulder and ultimate breakdown, I'd really encourage you to have a look at that pro analysis class. Outside of the market analysis, I mean, obviously this has gone a little bit longer than what I generally would like to do. I strategically stayed off the airwaves on Monday and Tuesday. We saw that bullish bounce on Monday, but I mean, even though I walked into the week somewhat bullish, the reason why I was somewhat bullish is because we do have a limited downside. And as such, on Wednesday, we have effectively put in the low. Tuesday, we negated it, and it's really just been a blessing as at the close, or at least the intraday movement on Wednesday, to finally see the Dow Jones establish once again a legitimate lower low. Outside of that, pardon me, we started to nibble on a couple of positions this week, anticipating the bullish bounce. One of those positions was Caterpillar. We had a bullish entry at $78.47. Obviously, at the close on Monday, this was looking incredibly healthy. A very nice bullish pop. On Tuesday, we pretty much broke even. I mean, we were right back where the beginning of Monday's candle formed. But as at Wednesday, we've got a very, very nice bullish engulfing candlestick pattern, which suggests that ultimately through this volatility, we are going to make it up to $81.66. So if you took the Caterpillar trade, I wouldn't worry all too much about it. It's a lovely looking trade, although we did have to stomach through and at least sit through some form of a short-term pullback. It's looking very, very good. Volume is starting to pull back in, and we're setting up a legitimate support level on Caterpillar. So if you are in this trade, and that is me as well, I'm simply going to put my stop in here about 76.70 and let the trade be. Understanding that we are at a macro support level on a lot of these markets, or at least the Dow Jones Industrial Average, and it sits perfectly well with what we expect on Caterpillar. The other quick stock which I wanted to walk through, I mean, actually there's two stocks. Goldman Sachs, I actually took this off the list this week and I didn't take the trade, but I mean, if we kept it here at 202, we hit our target today at 197. Again, I told you in full transparency, I wouldn't be taking the trade. The reason why is because the downside level that we were looking at is very limited, and we've pretty much put it in right now. We didn't know if Goldman Sachs was going to make it down to 197, so we sat the trade out. that's okay. So Goldman Sachs sort of worked out, even though we didn't take the trade. And the other stock, the major stock, the biggest stock, probably on the US markets, or the most widely followed at least, is Apple. Now, Apple's been going through an incredibly volatile state. It does look as though that we are setting up a base, and this is going to be a short-term base for Apple. So although we're sort of seeing these big gyrations back and forth, we started to look at positions about 118.69. It's still a really great trade setup. We are going to move up to about 122, 124, maybe even as high as 125 over the coming weeks on Apple. So a lot of doomsayers out there right now who are sort of perpetuating the myth of fear and panic right now, or the reason to be selling, couldn't be more wrong. And we are going to see a snap back to the upside on Apple. Outside of that, friends and traders, I'll recap one additional market, and that is the transports. Obviously, I've been very vocal on the transports as well. Since, again, we broke down in April 2015, we hit our first target at 8,000. When we hit our first target at 8,000, we moved short-term bullish on the transports. We saw a little pullback, but ultimately, we came back up to this resistance level. A very interesting candle, which is set up today. As at the close on Wednesday, it is what we call some form of a hammer candle. Now, we aren't really technically at support. We're sort of in no man's land again. I'd call true support down here at 8,000, but we have a clearly defined resistance level also up here, about 8,500 or 8,475. Right now, it really looks as though the Dow Jones is going to push up just a little bit higher, and it's going to work in conjunction with the Dow Jones Industrial Average. So as the industrials move higher, obviously expect the transports to move higher. But when I bring back up the transports, and again, this has been going for a little bit longer than what ideally I'd like to do on a Wednesday, but it's for your benefit at least anyway. So I hope you see the goodwill, is that this 200 simple moving average is going to be so important for the transports. If we do get a rally and we fail at the 200, or even if we push on up to 8.8, we'll see how it works in alignment with the industrials, and we see this roll over, and we see once again the continuation. Let me just zoom out a little bit for you. We see the continuation of what? Lower highs and lower lows, or at least a defined downtrend. Then that is very, very worrying for the health of the equity markets. Obviously, global trade is moving very close to recessionary levels, and we have to pay attention to that. It's obviously showing up in the transports, which is keeping our finger on the pulse of the markets. And I just wanted to bring you this very important update on the at least equity markets, because again, it's not really the time to be initiating new shorts. Instead, you'd rather be looking at enacting some long trades, or maybe not long trades, but at least getting exposure to potentially DIA trades, SPY trades, or the Qs. If I had to pick between the two, sorry, that's a horrible Qs trade. If I had to pick between the three, it would definitely be the DIAs. The reason why is because we are at that support level, and it works very, very nicely with the overall structure of the industrials itself. So, I mean, I'll leave it at that for now, this Wednesday afternoon market recap. I hope you saw the positives out of that and the clarity of this market analysis. Send me an email, success@pivotpoint-trading.com, or schedule a call with me. I need to make some calls, in fact, right now with a couple of students in the US and also Canada, which I'm going to do as soon as I render this video. So I must call it an afternoon or an evening right now. Have an enjoyable evening as well. I wish you the best for the rest of the week, and I'll be back with you soon. I'm not sure if I'll be back on Thursday or Friday. I'll see how the market stands, but I just really wanted to make sure I put this video out, because finally we hit it, 17,210. We're into the next phase, the next outlook, and that next outlook is up to about 18,000, maybe just shy of 18,000 on the Dow. Have a fantastic evening, everyone. I look forward to any questions which you have for me. It's James signing out on behalf of Pivot Point Trading. All the best. Goodbye.